Welcome to the Dealmakers Coffee Break. I'm Asaf Raz. Let's go. So yes, here's another episode of the Dealmakers Coffee Break edition. So we have Rich Bouchner with us. And Rich has such a great history. He's done so many things. Now he's in private equity real estate investments for H&W and family offices. He's been at Capital One. He's been at Waypoint Residentials for about 5 years. Equitas Capital Advisors. Like, you have so much experience in real estate. I want to talk about this too much. I want to give you the opportunity to introduce yourself. So yeah, Rich, please take it away. Let us know who you are, what you do today, and we'll take it from there.
Absolutely. Well, we just adopted a puppy, so right now I feel like I'm running around chasing a four-legged furry member of the household, but I'm not doing that. I've been in investment management almost the entirety of my career. A long time ago, I worked for Merrill Lynch right out of Tulane, and then went to business school at Vanderbilt and knew that I wanted to end up in kind of an institutional asset management world. So I made my way to New York, was with Brown Brothers Harriman for a couple of years on the buy side, talking about all different asset classes, stocks, bonds, real estate, commodities, focused on speaking with either family offices, high net worth individuals, institutional investors, pension consultants, folks like that. Spent some time at AllianceBernstein, also in New York, and then ended up in New Orleans, which is where I went to undergrad, and I was there for almost 10 years, primarily with Capital One. Capital One's wealth management group was based in New Orleans. They had acquired a bank, and they took the old trust department and turned that into a wealth management area for Capital One nationally. And I was one of the guys who's helping build out that business. Capital One decided at some point that they really just didn't want to stray too far from their credit card business, and they sold off the wealth management platform. And when I saw what the world was going to look like once those deck chairs were rearranged, I realized it was time for me to move on to something else. And I'd always been interested in real estate. I've done some investing, either passively or I own some properties, but I never really made a go of it as my full-time vocation. And I was presented with an opportunity, I guess at this point, going back 6 or 7 years ago, to join Waypoint Residential. Waypoint is a multifamily focused developer in the Sun Belt, and had a great run there. I learned the business. I used to be a mile wide and an inch deep. Now I'm an inch wide and a mile deep, when it comes to real estate. And decided that it was time for me to leave Waypoint. They moved away from a deal by deal structure into a fund structure, which is fine. But I really find that my client base, which at this point now is primarily high net worth and families, they seem to like deals more than they like funds. I think they like looking at each deal, getting into the offering memorandum, kind of being able to cherry pick their opportunities versus a fund. So obviously, you're drinking the Kool-Aid of the sponsor, which is great, but you have no real input once the fund goes to work. And so I left Waypoint and I joined Alpha Investing, which is where I am now. And we are a private equity real estate shop. So as opposed to being an operator or a sponsor where all we do is our own work, our goal is to find best of breed institutional quality operators in a variety of commercial real estate sectors, do a bunch of due diligence on them. Our lead due diligence person was at Lazard and Starwood and AllianceBernstein before she came over to Alpha. Has a lot of experience underwriting and doing DD. Once we decided that we want to move forward with an operator, and right now we're in tax abatement multifamily. We are in senior housing and single family rentals. But once we decide to move forward, we negotiate control rights. So we have the ability to say no to a sale or yes to a refi, whatever the case may be. We also have asset management guys on the team. So we're out walking all the properties. We're looking at financials on a regular basis. We're always on calls with our operators. But we take control rights. We bring the majority of equity to a deal. We like acquisitions. We're a cash flow shop, so we're really not doing any development at the moment. And raising money from either individuals or families, and in some instances, smaller RIAs or foundations. And I'm the lead capital raising guy in the team. Fark and Daniel, the two co-founders of Alpha, have done a great job of building the platform, and the majority of our investors have come organically, friends and family, old business school professors, friends of friends, colleagues, which is a hell of a way to build a business. And I give these guys a lot of credit. It's very challenging when you potentially don't have the best news to share with an investor, and that investor to be somebody you've known for 15 or 20 years. So very personal, and that's how we're building our network out. It's all people that are 1 or 2 degrees away from us, but I'm the first outside capital raiser. So my goal is to help bring in larger investors who are writing, bigger checks and maybe focused on, putting 250, 500,000 per deal to work versus a lot of our investors now we're between 50,000 and 200,000.
Wow. What a history and what a change you've had throughout your career. Well, you focused on real estate, real estate investing, but it feels like you've been through various cycles of real estate, not only through the companies you've been working with or for, but also for the different market circumstances you encountered throughout your career. And I feel like people like you really understand what's happening right now. And I'd love to hear your thought about the current state of the market, which people are, there's a little bit of fear. People talk a lot about how do you raise debt right now? How do you manage debt? How do you manage risks? And when I look at alpha investing, by the way, which I think connects really well, you talk about providing access to institutional grade assets with compelling risk-adjusted returns, right? So how do you bring that sentence to life with the current state of the market, the current conditions? And what is your strategy to kind of deal with what's going on?
That's good questions. A lot to unpack there. As far as what we're seeing in the markets, I always like to say that my crystal ball is as foggy as the next crystal ball. Otherwise, I would be having this conversation from my private Zeppelin touring the world somewhere. But I think the most dangerous words in any kind of investing are this time is different, right? People always say this time is different, and I have a secret sauce, and I'm going to figure it out. History. What do they say? History very rarely repeats itself, but it often rhymes. And I think what this cycle is showing us is that the cracks are not nearly as severe outside of all, downtown office as people thought they were going to be or want them to be. A lot of investors are like, Rich, you call me back when you can tell me we're going to have a 40 IRR or short-term hold with no risk. I'm like, oh yeah, sure. You'll be my first. What we're seeing is that you have a lot of sellers. First of all, buyers and sellers are still disconnected, right? The buyers are here and the sellers are there. And I think that's natural. Everybody thinks that what they have is better than it is, or everybody thinks they should be able to buy something for less expensive than the market is dictating. So that there will be an equilibrium. But you're not seeing, the sellers that need to sell now are the folks who have short-term adjustable rate debt. You're seeing that in some of the value add multifamily. The folks who, for lack of a better word, fix and flippers in the multifamily space. And that's a formula that worked really well until it didn't. And some of these folks have rate caps or cap rates, rate caps that will allow them to navigate through this, and they'll hold and they'll figure it out. The folks who are getting in trouble are the people who either didn't lock in a rate cap, or it's expiring and they can't afford necessarily to extend it. So some of those folks are either going to have to turn the keys back in, but I think what we've seen is banks don't want to own properties. So I've heard of some instances where banks are renegotiating very heavily, and sometimes they're even throwing in some kind of equity into the deal to make it work. They don't want to take the keys back. Or a lot of operators are obviously doing capital calls now. And a capital call isn't necessarily a bad thing. If it's a property that you believe in and an MSA that you still think makes sense, then sometimes you're better off writing that check and staying in the deal and living to fight another day. But what I see is, especially for folks who've gotten involved late in the cycle, they don't necessarily understand capital calls, and their first reaction is no. And, if you really think it's a crummy deal, then it should be no. But oftentimes these deals aren't crummy. And, if you put a couple more dollars in, you're going to be happy in, 3 to 5 years.
Isn't it hard though to call capital from your existing investors after you've properly you did the underwriting, right? You had your entire financial forecasting. You knew what the property is going to yield for you. And then all of a sudden you call them and you say, hey, I need more money. How do you deal with that kind of circumstance? How do you deal with that situation?
So I think it depends on if the original thesis behind the acquisition still holds. It's not that different than owning a stock, right? I mean, if you like Apple and Apple dips, what do? You buy more because you're dollar cost averaging in and you want to hold on to it. If you don't believe in Apple, then you sell or maybe you hold. And I think when it comes to real estate, it's very similar. if you think that, let's say, I'm just going to pull an MSA out of the air. Let's say it's Phoenix. If you think that Phoenix is softening, but over the long run, it's going to continue to perform, and your property is not performing because you're holding it longer than you anticipated, or your rate cap is expired and you need to lock in that interest rate by paying for another rate cap, then that's one conversation. If you see, let's say you bought something around the thesis that Amazon was going to build a data center, and you thought you perhaps needed more workforce housing. Well, Amazon pulls out and there's no more need for workforce housing. That's a different thesis. And at that point, it doesn't really make sense to move forward with a project because there's no demand for it. So yes, the natural reaction to most investors when they get that capital call email is like,
whoa, what's happening?
Right. But don't throw the baby out with the bathwater. It's case by case. If you believe in the thesis, then yes, I think it makes sense to put more money in to live to fight another day. If you think the thesis is blowing up, then cut your losses, take the tax, the tax loss, and move on to another investment.
So take me into a tour in your in your head. Why do you decide to invest in those three specific asset classes? What do you see in those compared to others? And you talked about Amazon, you talked about workforce housing, so we're talking about multifamily, senior housing, and single family rentals, which you're focused on with alpha investing. What's so appealing to these asset classes?
So what we like, we're asset class agnostic, with a caveat being that at least at this point, we want to see, we want to invest in sectors that we consider to be needs-based, where people need something. You don't need to go shopping at a strip mall. You don't need to stay in a hotel, but you need a roof over your head, right? And so the demographics of this country show us, of the U.S. show us that more and more folks are aging, right? And so the senior housing is, if you do it right, it's almost a no-brainer. Though a lot of people have stepped on landmines over the last couple of years in senior because they thought just because they knew how to acquire and run multifamily that they knew how to do senior housing. Senior housing is as much of an operating business as it is a real estate business. So my advice to anybody who's looking at senior is, yes, the real estate needs to make sense, but make sure your operator knows space, because the margins, if you don't operate senior correctly, you're going to blow your margins, and the real estate might make all the sense in the world, but you'll lose money on the actual operation. But we like to buy we like to partner, I should say, with operators who we feel kind of have a secret sauce when it comes to adding value to the deal. We're not buying a market saying our guy is smarter than everybody else, and so therefore his apartment building is going to go up more than everybody else's. That worked well. To your point earlier, when you talked about low interest rates, that worked well in a very low interest rate environment. You could buy Nashville, you could buy Austin, you could buy certain cities, and if you did okay, you were going to do really okay. That's changed. So currently we are partnering with an operator who focuses on tax abatement multifamily. And tax abatement works really well where I happen to be located in Texas. I'm in Austin, Texas. Texas is notorious for high property taxes, but also a shortage of workforce affordable housing. So this is middle income stuff we're talking about. We're not talking about, the guy working at the oil field. We're talking about policemen, teachers, firemen, med students. There's a shortage of that kind of housing. And by working with housing authorities and agreeing to rent restrict or income restrict in some cases, generally 50% of the units in an apartment building to 80% of the area median income, we end up getting a 99-year property tax abatement. So think about it for a second. Let's say the last deal we just did is in Dallas-Fort Worth. Average income for a family of four in DFW is $100,000. So if we get to 80% of that, that's $80,000. The majority of the tenants in the building were already at 80,000. So it's not like you're kicking a bunch of people out to move more people in. Most people qualify at 80%. And so we were able to save $1 million a year in property taxes by working with a local housing authority. So a property that we bought that was valued at $70 million without the tax abatement became an $84 million property on day one. So our cap rate was 4 going in, and it was 6.5 with the cap rate. I don't know what's cap rate with the tax abatement. And it's a 99-year tax abatement, and it's transferable to the next guy. So you can hold it for 5 or 6 or 7 years and sell it, and they still have 90 plus years of tax abatement. And then when we look at senior housing, we're working with an operator who's been in that space for a very long time. Senior is very fragmented. We're not buying, the stuff that KKR or BlackRock or Blackstone, which a big operator wants. We're buying from mom and pop operators. They typically own a couple of facilities. They're in their 60s or 70s. They don't have an exit strategy. Their kids don't want to take the business over because it's a very tough business to run. And they don't necessarily run their businesses as efficiently as maybe they could because they only own a couple, right? So they're not getting great pricing on food or staffing or linens. Our guy kind of knows the space. He hangs around, these deals. He'll wait for somebody to fall out, which is happening more and more on a purchase. They can't get financing, whatever the case may be. He'll come in, offer a couple $1,000,000 less than what the previous offer was, and he's winning deals. We just bought 2 properties in Idaho at a 13 cap that were 96% occupied in the senior space.
Wow.
Scenario. We need a secret sauce to find value, and we're finding it in senior. We're finding it in tax abatement multifamily. And it's a little more challenging in single family rental now because interest rates have moved up. So we typically buy those in cash and then put debt on them. At this point, we're not putting more debt. We're not acquiring anything at the moment. We're using debt because rates have moved up. But we'll see if it changes over time.
So I feel like the number one output from this entire part of how you focus on your asset classes, and you correct me if I'm mistaken, but I feel like knowing the type of asset class, right? Knowing what to buy and how to buy it, right? You need to have your formula of how to buy it, but most importantly, knowing how to operate it. Specifically where the interest rate environment is so high, you have to know how to run the business, which, by that means that you need to understand how multifamily runs. And you need to understand how seniors live in senior housing or have the right partners to do that. Because of such vast experience you have, I'd love to hear one property or investment story that you have from your history that you think is worth sharing because the story is so special.
What I can say, and it goes back to what I said earlier, is, and I learned this phrase, and I don't think Lou came up with it, but when I was with Bernstein, I was in the elevator with Lou Sanders, who that was the chief investment officer for Bernstein. And this is before Bernstein became Alliance Bernstein. I was working on 6th Avenue in New York. And Lou said, the most dangerous words in investing, this time is different. And this is a guy who was one of the most well-regarded value investors, I think, in the history of value investing. The thesis that Bernstein always stuck to was, and sometimes it didn't work out, but they did their research. And if they believed in their research, they held on to things. They didn't care what the market said. And if they really liked it, they added more. And I think that's good for life in general. You do your research, believe in your thesis. If you don't believe in your thesis, then it's time to pull the ripcord and walk away. Don't look back. Don't get emotional about it. But don't, we how many bubbles have we all seen burst? And how many times do we invest with fear of missing out? So, stick to your research, have a thesis, realize that you're not always going to be right, but that's okay. When you're wrong, be ready to move on. And if you believe in something, buy more of it.
Great. So here's the time for a shameless plug. If you specifically or Alpha Investing is looking for anything nowadays, or you're opening a new offering, a new deal, and you want to raise capital for, that's the time.
Cool. Well, thank you for that. So because this is shameless, I'm going to touch upon all of his.
Go ahead.
Alpha is over the next couple of months, we're going to bring a couple more tax abatement multifamily out. So if somebody's looking to get into multi, these are fairly low risk because the value of the properties go up, 20 to 25% with the tax abatement. We get fixed rate debt on them, and 60 to 80% of the depreciation gets pulled into year one. So if somebody has a bunch of K1 income somewhere else and they're looking to offset that, these are great deals because of the accelerated depreciation. If anybody's interested in tax abatement multi or senior, please get in contact with me. I'd love to talk to you and see if we're a potential fit. Alpha is always looking for operators, folks, again, who are doing something with a twist. We're not looking for folks who are right down the middle of the fairway. We want to know that the value in the deal is baked in even before we move forward, and we're not relying on, demographics or people moving to an area, whatever the case may be. So if you're an operator who kind of fits that bill and something that is a need and not a want, we'd love to talk to you, because right now we've got 3 or 4 operators on our platform, and in a perfect world, we'll add 1 or 2. And then generally, we're always looking to talk to families, high net worth folks, smaller RIAs, smaller endowments, anybody who understands that real estate should be part of their overall asset allocation. And if you're looking for a shop that does a ton of due diligence, is very transparent, there's 9 of us. We're always available. We, the founders, the principals will always get on the phone with you. We've built a pretty good back office. So when it comes to our data rooms and our website, almost all the information you need is right there. So if you want a shop that's going to talk to you, that's doing interesting deals, focuses on downside protection, we'd love to have a conversation. So that's my shameless pitch.
I love it. I love the shameless pitch. Rich Bouchner, thank you so much for being in our show, for being in my show, and for answering all the great questions. It's been really valuable. So yeah, thank you. Thank you for joining us. Check out more episodes on the Dealmakers podcast, available on Spotify, Apple Music, Google Podcasts, and Agora's website at agorareal.com/podcast. See you in the next episode.